Cutzler YMX uses the Netrodyne two-way camera system in all of our power units. The Netrodyne cameras have more than once exonerated a driver who was perceived to be at fault, as well as saved our Cutzler YMX from paying damages related to an accident. We are already seeing, just in 1 year of Netrodyne, the impact of better safety scores and fewer damages and incidents in our insurance rates.
October 17th. For those of you tuning in live, welcome to Freightonomics, where we mix that supply chain transportation market information with the global macroeconomic environment. I'm Zach Strickland, head of market intelligence. Tony Mulvey,
senior analyst,
here to break it all down for you. And of course, Tony, we are coming out of a period of where we thought we had some chances to really throw supply chains into chaos. Mm-hmm. And it doesn't appear that that's necessarily the case.
Yeah, maybe not.
A little bit of a disruptor.
I think there's signs that maybe the market is more ripe for some disruption. I think some sensitivity, and we're going to touch on it here in your marketing too. But I mean, you look at Florida markets, like they were impacted by the hurricane.
Yep.
Southeast largely was as well. I mean, if you were to go look at Atlanta, like there was a reaction to that. But then you start looking, like it wasn't just the Southeast that saw some pockets of disruption over the last 10 days. Like you saw it in Dallas, you saw it in Harrisburg, you saw it in Chicago. You kind of out basically everywhere except Southern California, which kind of goes into the thinking like you're gonna see what's gonna show these signs of a market turn or a market change is these pockets of regional disruption showing up. And I think you're seeing the signs of that, maybe I call it a little early, but you had like some disruption that sent it into this way. So I think overall you're seeing the signs that we need to see.
Yeah, I mean, I think we're going to discuss J.B. Hunt's earnings. We're also going to talk about Triumph Pay here in a little bit. They had some good quotes in there talking about how they're seeing signs of recovery, though we're not necessarily in a market that I think a lot of the transportation service providers feel confident in their operating abilities due to the amount of demand. And it's because there's still just so much capacity. And I think that's still something we're bleeding through. People need to think about it differently. I think the market in two, I'll have some charts here in just a minute to go through to explain this and show it visually. Yeah. But first, let's thank our sponsor. Remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate. And of course, those are bad, so you don't want to have an accident, especially in this operating environment, which is still very challenging.
Absolutely. And just to highlight how challenging it is, Zach, we'll get to that market in two, so I'll count you in if you're ready in 3, 2, 1.
All right. When I talk about a slow recovery process from a transportation service provider aspect, this is what I'm talking about. This is our outbound tender rejection index, measuring the percentage of loads being rejected by carriers for their shippers, for their shipper accounts. And we are up over 5%. So that is a large number when you think about it over the course of the last 2 years. 5% is a historically low number, meaning soft capacity, easy to go find a truck. But from where it's been, we're coming off of the floor. We continue to grow off the floor. Now, we wouldn't have been over 5% probably without Hurricane Milton, which I think really threw things up. But also we had the ILA strike and Hurricane Helene. Neither of those were huge by themselves, but I think in combination, the trifecta really helped push these rejection rates higher. Now, they did hit at a time where the tide was out. So it was hitting at low tide for the freight market. So it probably could have been worse had it not hit in the beginning of October, where we traditionally see pretty loose environment in general, or loosening conditions. Let's look at a specific impact to the Lakeland market here, which is going to be Lakeland, Florida, so Central Florida, inbound and outbound tender rejection index. Inbound rejection rates far exceeded the outbound rejection rates because Florida is a backhaul market. You can't get freight out of it, so carriers naturally reject freight going in there more. Outbound rejection rates spike, though, as well, and they're still very high, but we are starting to see both of the rejection rates come down for in and out. Still much more challenging to get a truck into Florida than out if you are looking to source capacity. Let's look at the next chart here. Look at the NTIL. The big takeaway here, and we're going to hit on this a little bit more later, spot rates nationally didn't really move. We don't see this huge push of rates higher. However, if you take fuel into the equation, spot rates are higher than they were last year. Whereas if you kept fuel into it, as you do with NTI, spot rates are flat.
Yeah. And I think that's interesting because you look at fuel right now, it's vastly more expensive than what it was.
Yeah, we're going to hit on that later because Triumph's data...
Or cheaper now than it was a year ago. It's down like 20% cheaper than where it was.
Year over year is dramatic. Yeah. Nobody's paying attention because it's getting cheaper slowly. It's a slow contraction. So when you're looking at rates, the big takeaway here for you data people out there, watch out. Spot rates have a lot of noise. They're measuring lots of different things. So the aggregate rate that you're looking at here, an NTI, which is the yellow line, that's going to include fuel and all the other costs included in it, flat from last year. If you take out the total impact of fuel cost, rates are actually significantly higher than they were this time last year. So there's a cost deflation from fuel being included in aggregate rates.
Absolutely. I want to bring up the OTRI chart again, because I think it's really interesting when you look at the amplitude of these moves, right? Look at, call it Labor Day, then call it the week before the ILA strike.
Right.
And now you kind of had the ILA strike and then Hurricane Milton. It's like we stacked, basically they've been in this range with the volatility, and now we've exceeded that. Much more in line with what you see holiday-like levels last year, which to me, we've been trending higher. It sets this market, or this year, you're going to see rejection rates higher than where they were last year around the holiday. I don't think there's any question in that, especially when you look at what happened around 4th of July.
Well, look at where we were last year in terms of rejection rate. This market was like the low end. And then, of course, in May, things bottomed out there as well. But the trend line is up, but it's slow. And again, the scale is making this a little bit noisy. Now, the interesting aspect of rejection rates being where they are now is that this is bid season. There's a lot of people going through their annual bid cycles, and having these disruptions may have added a basis point or two. I do have a chart here because it is bid season, and spot versus contract chart, if we can pull that one up. So everybody's wanting to know, what do I bid? So the contract rate line there in white, that's flat year over year.
And it's been in such a tight range. We're talking like 4 or 5 cents throughout the entire year. And I think to me, that's a signal that we've basically found the level that shippers are comfortable at paying, where carriers can continue to operate and accept freight. I think this is where you start to see maybe some upward rate over inflation. You've seen it since what, May? We kind of bottomed out and moved slightly higher since then. I think you're setting up for 2025.
We've bottomed on the contract.
It's going to end up being, I think contract rates are going to be up year over year. Next year. Now, is it going to be 10, 12%? No, but I think what you're seeing is that there is some rate inflation so from a carrier perspective, you've got to be happy to some degree that you're not having to bid so low that you're running yourself out of business.
The fascinating thing to me is that spot rates are still well below contract rates. And again, our contract rates are shipper to carrier. They're not the managed transportation rates. They tend to get negotiated lower because brokerages are better negotiators, but they're also leveraging a much wider net
Yeah, when you have
a carrier
100,000
network.
carrier net or
Lots of
100
backhaul
Yeah.
that they're utilizing there versus just a handful of carriers. That's why those rates tend to be lower, but they're also more volatile, and the service is more volatile at times too. Now the broker, of course, that's their job to manage that, so the shipper or their customer may never notice. But if you look at the spot rate there, it's still well below it, and yet contracts now have an upward momentum under them over the last 6 months.
Yeah.
Rates are actually up about 2%. Versus where they were 6 months ago on the contract rate side. So there is upward pressure on contract rates, even though this market is still extremely oversupplied and very loose.
Yeah.
That is a fascinating thing to me.
I think you mentioned it there. I think some of it, why it feels this way, is one, that you've got the rise of brokerages that kind of are better negotiators. Those that play in the, from the carrier perspective, those that play in the spot market aren't going to feel this. But then you have the large carrier, and I think we're going to touch on one. Granted, most of that's intermodal, but you can see kind of their ability to, their negotiating tactics, like they're servicing this freight with relative ease, but their customers know that they don't want to deal with the volatility.
No.
They don't want to have to move freight into spot, right? So I think that's some of it too, is they're managing against the volatility. They're avoiding that by keeping that contract rate, up.
Well, the value of a 12-month service is very different than a daily, and that's what you see on the spot market. You're valuing that service in the moment, that day. You're leveraging a much wider range of carrier networks versus just a handful. And that's why the spot rate tends to be lower. But at this point, the market's still very loose. Looks like bid rates are going to be flat to slightly higher. And we've talked to Dr. Rogers about this. I think part of the reason why these rates have a floor is not just pricing discipline from a carrier's perspective, where they're like, no, we're just not going to lower the rate any longer. It's the sentiment has been widely accepted in the shipping community that
things are going to get tougher.
We can't squeeze much more blood from this rock. And therefore, I think it was a 76 on the 12-month pricing outlook from the shipping community.
Yeah.
They expect a big increase in rates over the next 12 months.
Yeah.
And I think there's a lot of reason to expect that, or at least be wary of it.
Yeah, absolutely. And I think it kind of sets the stage for y'all's state of freight this afternoon.
Yeah.
Just having these conversations, kind of what to expect from peak season and then moving into 2025.
Yeah.
I think overall things, if you're a transportation service provider, I think things start to look better as we move into.
Still not great.
Yeah, no, but it's better than we're not sitting up here expecting rates to fall another, 5-10%.
Yeah.
So,
well, speaking of peak season, I think retail sales came out.
They did.
What are we taking away from retail sales before retail peak?
So September retail sales came out this morning, up 0.4% month over month, better than expected. So expectations were for 0.3% increase. So not a huge beat, but beat nonetheless. To me, it's a signal that consumers are continuing to spend. If you exclude autos, up 0.5%. So really strong, call it. Well, it's even better when you start taking out gas spending and things like that, which gas spending is down for the month,
right?
But it's solely a factor of price declines, because if you look at the CPI,
deflationary pressure.
It was down 2.9%, I think is what it was month over month. Yeah. So seeing an increase in spending, real spending, when you take out that inflation. But you look at some of this, the detractors from retail sales have been the same. Yep. It's been furniture, it's been electronics, things like that continue to be the drags. But then you've got miscellaneous store retailers. So kind of a broad topic there. But then you've got food and beverage up 1% month over month. Clothing actually up 1.5% month over month, up over 3% year over year. It's something you haven't seen recently. So seeing some signs that, again, the consumer's still willing to spend.
Yep.
And then you factor in,
and that's before Christmas.
Well, it's before you had
Yeah.
This is September, so it's before you had Amazon Prime Deal Days or whatever they called it at the beginning. You had Target's Circle Week. You had Walmart pushing their deals, Best Buy pushing their deals in the first week of October, first 2 weeks of October. Like, it sets up for retail sales in October to be like, we were expecting some slowdown at some point because you had a really strong July. You expected a slow August. Didn't really see a slow August. Then you saw a September that was stronger than that. So you're just like growing on these like strong retail sales figures. The question becomes like, does the consumer take a break?
Yeah. Did we just mute the peak season activity by spending in September?
Yeah.
Is there a little bit of a pull forward? We'll find out.
We will. I think you'll see some of that show up in October. I think you will see the pull forward. I think
Prime Days.
I think what we've done is, and I think we talked about it with last week with Dr. Zach Rogers, is the peak is no longer just November and Black Friday.
Right.
Like it's still there. It may be muted, but longer, as opposed to having like a true peak.
Right.
So it may last, 8 to 12 weeks versus 3.
Yeah. And even into January a little bit.
Yeah.
So it's changing. Things are changing. But let's get into the news of the day, which I think one of them, the first one up for our Newsonomics section, I think this is something this is more of a generalized, we need to be watching this trend, especially we've got election coming up. Mexico, North American trade is going to become a huge factor in evaluating domestic supply chain, even global supply chains at that, because a story here, of course, if you don't read Borderlands by Noe Mahoney, you should be. Mexico, U.S., Mexico trade hit $74 billion in August. Port Laredo, number one again. Of course, this is total trade, export, and import. So lots of goods moving back and forth between these two. You need to understand this trade lane if you operate in North American transportation. U.S.-Mexico trade total $73.7 billion in August, an increase of 4% from the same time for the same month 1 year ago. According to the Census Bureau data. So they're increasing their share in their terms of value. Now, Canada is number 2 with $63 billion, and China is third at $51.8. Now, that is largely due to the gross imbalance with China. And of course, we're talking dollars, not physical goods.
I think that's my challenge when talking trade is that it is in dollars. And if you look at some of this, like, what do we import and export into Mexico and back? I mean, automotives is probably the biggest one. I think auto part, you had it here, top imports from U.S. to Mexico in August for gasoline and other fuels makes sense because we have a lot of that infrastructure along the Gulf Coast. Move it south, pretty easy. Auto parts at $1.74 billion. So you're talking what?
Computer parts, $1.73 billion.
By the time you add those three together, you've made a lot of that money. Or seen a lot of that, where that trade is, the dominating kind of import, the movements of goods. They're really outside of the fuels. Well, they're high value goods. So it inflates that to some degree.
For sure.
But that's why it's so important too, right? Is they are those higher value goods that are important to the overall U.S. economy.
Well, I mean, I think Mexico has largely been an automotive producer. A lot of parts and stuff come out of Mexico for final assembly. Of course, China has also been importing goods more frequently into Mexico for the cross-border trade. That's a part of it. So it's a derivative of that Chinese trade a little bit.
And I want to see how this I want to see if, pending the election and how things go there, do these change over time? I think that's going to be more telling of like, okay, is manufacturing moving into these areas? Because if you go and look at like the wage growth, like and the cost of labor, it's far more expensive in China than it is in Mexico right now. And it's been that way everybody thought Chinese labor used to be extremely cheap, and it was. It's not anymore.
Right.
As the country's developed and the economy's developed, like there's still, I wonder if you'll see this shift and the trade.
Well, the election will have a huge bit to do with this. They even say some companies are playing the wait and see game pending the results of the election. they named Tesla in here as one of the big ones.
Yeah.
Of course, Mexico has its own set of challenges to deal with. Mexico trucking rates continue to hold and are on the rise due to increased demand and lack of drivers. Now, Mexico, very different than United States in the way that there is increased theft, violence on Mexican highways. It's very challenging to recruit a driver to, they basically drive during the day.
Yeah.
And there's a single corridor that they can drive in relatively safely during the day because it is not as stable of an environment as we have here in the United States. And that's just the way it is for now. So that makes Mexico maybe, that's why rates go up there is, yes, you can have abundant drivers here, but not necessarily somebody willing to drive in Mexico.
Yeah.
So definitely something to monitor. So JB Hunt always reports first.
Yeah. And I think it gives a lot of insight into, I think they get misconstrued a lot if you talk to financials or those that play in the financial market, because they say it's a trucking company, and JB Hunt is not a trucking company. It is an intermodal company that has a brokerage attached to it and then a dedicated service that is quite strong. Their truckload space is actually quite small relative to the overall
tiny
business.
Piece. It's a large trucking company in general, but it's like that piece, it's $170 million-ish,
of a $2 billion.
Yeah. It's not a huge piece of this institution, but it is a relatively, it's a 2,000 truck fleet.
It's not small, but that's not their
primary business.
Yeah. They're a intermodal company.
So my takeaways here. So JB Hunt primary revenue generation comes from their intermodal. So containers going on the rail, shifting, moving across the country largely. So this has been a huge kind of relief valve for the transportation market in general, because we've had all these imports coming into the West Coast, ILA strike, also having shippers kind of shift their shipping patterns into Los Angeles, Long Beach, even more so. And then there's this long haul freight that goes from Los Angeles to Chicago, into the Northeast, into the Southeast, where they get staged for a period of time. Intermodal does this cheaply.
Yeah.
Much more cheaply than a truck. Now the service and the touches on it are a little bit higher.
But it's gotten better.
It has gotten better. And they've been very good at it over the last couple of months, and they've grown share. Now, the problem with this is that as they are handling this efficiently, they're actually creating a low rate or helping maintain a low rate environment, which actually hurts their business in the near term. Yeah. So while they are gaining share, they're taking away this 4 to 6 days of a long haul truckload on these rails, and it's keeping the market relatively tame. So we're not seeing the inflation, and it's reflected here in their earnings. Now their revenue is up slightly quarter over quarter or year over year, Q3 over Q3, 0.1%. Volume was up 5.1%. Their load count was up 5.1% versus the quarter 3 last year. But their revenue didn't move. Their margin was down.
Yeah.
So their OR went up to 92.8% from 91.8. So that just means they made less money doing more.
Yeah.
And whereas making 7% in transportation is a good figure, it is not. This is still not signaling a very healthy movement.
Yeah. No, and I think it's interesting. I mean, you look, they've been very good at reducing their cost, but not to the same level they've grown revenue on a per load basis. I mean, revenue per load down 4.8%, cost per load down 3.7%. So they're doing things that once that revenue generator turns back on, like they can capitalize on it. I think the part that stands out to me is the average number of containers in their fleet at quarter's end. 108,000 containers this year compared to 100,000 last year. Oh, an 8% year-over-year increase.
That's additional capacity.
I mean, exactly. We've talked about reducing capacity on the truckload side. Intermodal side's growing it, but they're also able to. I mean, it's the way I like to see it is, how hard is it to put a container on a truck versus adding a couple containers to the back of a already 2 mile or a mile long train? It's a lot easier to stick them on the back of a train and move them. It's So to that degree, it goes into these long haul. And then you look at the price difference.
Yep.
I mean, if you looked at it, and really the one that stands out is if you looked at the NTI, so truckload door-to-door spot rate versus the intermodal spot rate. Not a very large percentage moves intermodal or on spot on the intermodal side, but it's just kind of a proxy, that spread between the two. I mean, it is significant. And to me, it shows the rails and intermodal marketing companies dropped their rates in an effort to capture as much volume as they could, something they haven't done in the past.
Yeah, this right here, everybody's worried about trucks leaving. Guess what? Most of the freight growth that has occurred has been from Los Angeles to Chicago and points east. This is what's helping keep the market loose, is this mechanism by itself. Like if we talked about trucks being flat year over year, there's still too many trucks, still too many drivers right now. But it's not. It would be much tighter if not for mechanisms like intermodal stepping in.
It's a relief valve. I think the other interesting part is their brokerage. So ICS has kind of been.
There's good results here.
Compared to what they've been recently. I mean, revenue down 6.7%. I'm not going to read too much into that. But revenue per load up. So tells me volume was down, but they priced it better. And then you look at gross margin percentage.
Expanded margins.
By 500 basis points.
Huge.
I mean, that is, one, it tells me they're buying capacity better than they have been. And the price that they were charging their shippers has basically, it stopped the bleeding. It started to go back up. So, and then they've reduced their head count. I'm not going to make a big deal of that. But overall, they're far more efficient than they have been.
Well, they're pricing better. They're able to expand their margins in a relatively flat environment, although we did have a few disruptions in Q3, which probably helped boost that a little bit.
But we've been up here talking about how they've had a pricing problem across their entire business. Well, it proves that they've kind of recognized that and they've taken the steps to improve it. So.
Now, the piece of their business that I am a little bit wary of and concerned about, now, everything I've talked about in terms of concerning has been market driven, not necessarily JB Hunt driven. Dedicated is the one segment that I put kind of like a circle around dedicated. Pure contraction. Revenue, loads, everything, they kind of shrunk. Looks like they lost some business here. This is interesting to me. This feels like somebody has pulled this into private fleet.
They've either pulled it into private fleet or they're playing the for-hire market that's offering a discount.
This is interesting. Like, I mean, and this is what happens in this cycles, is dedicated business doesn't have as much advantage because I can go and find a truck, no problem, without spending money for it being there consistently.
I think, and it's almost on a lag. Because it's like, you have to see how the cycle is going to play out before you start making those decisions. I think the other side is there's been a lot of investment made in private fleets, and that hurts dedicated business, especially when you look at some of the largest shippers.
Although, I don't know that it's private fleet, Greg. I think, so the other two kind of have negative market takeaways. This one, to me, actually has a positive market takeaway because I can use dedicated as a proxy for private fleets. If companies are saying I'm no longer going to purchase dedicated, guess what they're doing with private fleets? They're pushing them out. They don't want to haul air for their own trucks because it loses money, especially if they can go get it. So this may be the signal that most carriers are looking for, that this is a cycle that is in turn. So we've had intermodal being a relief valve. We still have trucks leaving the market. The shippers willing to spend money on consistency going away. So this is a market in transition.
Absolutely. I think the hard part is picking out exactly when that happens. And it's not going to be a single date and time of like, hey, it happened right here.
Right.
It's going to be long and drawn out. And I mean, you could look at it. I mean, you said it. We bottomed out in May. If you look at rejection rates, moved up, came back down, but the trend line overall from where we were, call it mid-May to now, is up and to the right. That trend line continues. It could have a long tail.
Notice we didn't even talk about the truckload segment. Actually, it did better. So, and from an OR standpoint, but again, without knowing some details of it, could be cost driven.
Yeah.
All right. Well, that'll do it for this week's show. No disruptions this week,
No
Tony. We'll see
Not
how the
yet.
rest of the month plays out. Have a great week.